I want to get into KKR and the private equity industry in just a minute, but maybe we could start with a news peg today that we've seen, which is that Louisiana has announced that it's divesting from BlackRock's funds over its ESG policies. This is kind of a microcosm of a larger trend that we've seen over the past year, largely over the last year, although it was percolating over the last few years. And the reason I want to start with that with you is that you do have some experience in politics. So you have this unique expertise where you straddle both the political side of things as well as the ESG side of things. So I'm curious what you make of it, given that, you were Bush's campaign chair in 2004, chairman of the RNC. There's been such a fractionalization and politicization of this issue. What's your take on all of that?
Look, a lot of issues today have been politicized, and I can't speak for either Louisiana or for BlackRock, but I'll tell you how we think about it at KKR. From our perspective, ESG is a way to make us better investors. And we think that's true from three perspectives. First, you were just hearing your previous speaker. There are enormous opportunities for investors to do very well financially and solve critical problems. You heard about sustainable air fuels. That's one example. We have a platform, for example, that's helping Amazon and other e-commerce companies make their products shipped in a container that's the exact size of the product. That saves the e-commerce company money. It's also really good for the environment. We have a platform that in Spain is helping upskill workers with vocational training that's going to help make sure there are enough workers to fill jobs. So there's a tremendous number of opportunities for investors to get very strong returns by solving critical problems. Second, we view ESG as an opportunity to help de-risk companies, making sure the companies we invest in, for example, have good governance, are focused on cyber hygiene. And finally, something you've covered a lot, we've discovered that if you engage employees by having employees own the stock in the company alongside you, often that improves productivity, it reduces quit rate. And so the way we think about it, it's not about divestment, it's about how we as investors can do better as fiduciaries for the men and women on whose behalf we invest by focusing on ESG, focusing on business, material, and smart areas we can invest, and how we operate those companies.
So behind the scenes then, Ken, because you have a lot of stakeholders at KKR, you've got the pension funds and other LPs that invest in KKR, you've got employees of your own, you've got portfolio companies with employees, as you mentioned, the stakeholder model, which was one of my favorite stories to cover this year. Behind the scenes, are you getting pressure from one side or the other to be more ESG friendly versus be less ESG friendly, or what do those conversations look like?
I think what we hear from our investors is they want us to be ESG smart. And for us, ESG smart comes down to one, where you invest, investing in themes like the energy transition or workforce development or circular economy companies that helps reduce waste, which both saves money but is also good for the environment. And then to think about ESG with the materiality lens, where we're focused on what are we doing that makes sense for this particular company to make it a better company, to reduce risk, and to create value at that company. So again, I think like a lot today, we have a debate that's very ideological. We think about it practically. What makes us better investors? What helps us produce better returns? And what we've found is there's a whole series of areas like employee engagement, like emphasizing diversity, like focusing on helping companies reduce the energy that they use and the forest products that they use and the water they use, cybersecurity. Every one of those things has a bottom line benefit, and it also makes our world a better place.
So then how does that work? How is KKR's approach to ESG? How does that work on the ground? Do you have certain metrics that you hold yourselves accountable to? Is it kind of a case-by-case basis, depending on the portfolio company or depending on the investment? How do you really kind of dig in and make sure that that risk assessment model is taking shape, as well as things that will drive returns?
It's a great question. So when we consider an investment, we have an investment committee. And the investment committee looks at not only the particulars of the company, but it also looks at the broader world. For example, it looks at the overall macroeconomic situation that faces that company. It looks at the company's supply chain. And when we're looking at that company, we say, what are material, meaning relevant to bottom line, ESG issues, both risks and opportunities around a company? So for example, if we're buying a manufacturing company, we're going to focus a lot on safety. We're going to make sure we understand the company's safety record. That's critical to the workers. It's also critical to the company's bottom line. But what we found over the years, in addition to focusing on those company-specific material issues, that there are certain things that if we do, we can help either reduce risk or increase the company's performance. When it comes to reduce risk, some of them are pretty obvious. How good is the governance? Does the company have a serious process when it comes to governance? We also look at things like cyber hygiene and cybersecurity. Is the company careful with its data, and is it protecting privacy? We've seen example after example after example of companies who don't do that end up in the wrong place. But then, as you noted a minute ago, we found some other things. We found, for example, that if employees in our companies outside of the C-suite own stock in the company, a meaningful amount of stock, and if they have voice in how the company operates, and if they have financial literacy to understand what they can contribute to the company and what their stock means, we found that it improves productivity, it reduces quit rate, it makes the company better, and it makes the company worth more. A recent example that you all covered very much in Illinois, an example of a company that made garage doors, where it was a very successful investment, and that success was earned by the workers. So again, I think it really comes down to the specifics. And what we've found, we've been working on this for more than a decade, is there's a series of levers we can pull that can help both make the company better, reduce risk within the company, deliver better for our investors who invest with us, and, by the way, make the world a better place. And that's how we think about it.
I want to ask you specifically about oil and gas investments, because there was recently a Wall Street Journal article that laid out how different private equity firms are kind of thinking about it in different ways. And on one hand, you have firms that are still investing in that area. Others have said, no, we're actually going to shun this from now on over concerns about climate change. In that piece, it said that KKR hadn't really yet drawn a line in the sand on that front. How are you thinking about oil and gas specifically as it pertains to the current environment?
So we have a company, it's a public company in which KKR has a majority-owned position called Crescent Energy. Crescent Energy invests in oil and gas fields, existing fields, and it focuses on doing so in a way that is specifically focused on both delivering good returns and, importantly, improving its ESG footprint. So we were one of the first energy companies to sign on to a protocol called OGMP 2.0, which is focused on identifying methane, reducing the amount of methane by measuring it at the source. We also focus on improving safety and limiting impact on natural resources. The reality is that today, 80% of the world still gets its energy from traditional sources, not green sources. And the reality is, if we don't have responsible owners that invest in those, what we worry about is you'll have irresponsible. And we certainly don't want to forget the lessons that everyone has learned from what happened in Europe. In Europe, because there wasn't an energy transition, we ended up in a situation where a whole lot of free countries were reliant on Vladimir Putin, and Putin was able to essentially blackmail them by virtue of their dependence on his energy. The way to avoid that is to have a real transition. And a real transition, we think, means you invest tremendously in new sources. We've invested $25 billion in the last 12 years in renewable energy sources, in energy efficiency, in companies focused on dealing with the impacts of climate change. And as part of the transition, we think the responsible approach is to invest, as I said, through Crescent Energy, in existing traditional sources of energy, and it's not but, it's and improve its footprint from an ESG perspective, from a safety perspective, from an employee perspective.
You also run impact for KKR. How do you think about impact versus ESG? I know those terms are often conflated, and in the private equity space, it's a little bit different than, say, public equities or more liquid markets.
So from our perspective, impact is a definition of where you're investing. ESG is how you invest. We do ESG in everything that we do, again, with a materiality lens. With respect to impact, what we believe is there are certain trends around the world. I mentioned the energy transition. Sustainable living. You just heard from a leader when it comes to one of the great airlines of the world and all the stuff that they're doing to be carbon neutral and to be more environmentally responsible. Well, think about all the companies that help them do that. Think about all the suppliers, all the providers of services. We invest in those and we help build those. And what we found is there's an opportunity to make those investments and do very well financially. A third example, and we'll use the airline industry again. One of the reasons this past summer there were so many delays was there weren't enough pilots. There weren't enough people that were trained to do the jobs that need to be done in the airline space. By the way, same thing's happening with nursing, same thing's happening in a number of other industries. We have platforms that we've invested in around the world that help provide the vocational training as well as the data that companies need to figure out what skills are necessary for that training. And so if you look at the world from the perspective of what are some structural challenges that need addressing, what we believe is there's an opportunity to invest in those and address those challenges and at the same time do very well for your investors. And that's where we're focused through our impact strategy.